Dan's chair or Franklin's chair, right? We hear from both sides of the aisle, and you know, after the election this time around, the Republicans all thought that their life as they know was coming to an end, and the Democrats all felt that they were reborn, right? And as dull as this all may be, our lives for the most part are the same. The day before and today, right? The day before the election and today. And so, you know, what's most important is the stock market's the same, right? And I will show you in a few minutes that, you know, what we predicted came true. So we had a call in November. For all the new people on the call, we had a call in November, and we predicted the different outcomes. We didn't predict who would win the election, but we predicted given outcomes here. And so we're going to go over that in just a few minutes. So as Lizzie said, what we're going to do, we're going to look at the predictions that we made for White House and Congress, basically that there's a Democratic sweep. So we're going to look at that. We're going to see what changes do we think are coming in the tax law. And for those of you new on the call, I'm a CPA, highly involved in tax type stuff. So we'll look at that as well. Doug is going to talk about mostly, I believe, our moderate portfolio as the mass amount of people have those. And so we'll look at 2020 and also take a look forward in 2021. So if we, Lizzie, can you start the slides, please? Would you? Hey. So let's look at the next slide. And so look, here was our projections based on, at this point, what happened in this election. And this was clean, contested, or baseline. And so we had a clean result here. And so, and if you can look at our predictions, which for the S&P was 3650, and this was towards the end, this was at the end of the year, the S&P ended at 3756. The NASDAQ, we predicted at 12,500, ended at 12,877. I mean, we're pretty close, right? And most importantly, what we weren't concerned about was who won. It didn't matter to us as we made these predictions. We were only concerned that someone won. And more importantly, there was no contested election, right? And that's really what happened. Yeah, there was a little bit of, pushback, right, by Trump, but really turned out not to be contested. So if we look at the next slide, this slide I stole from the call as well. Lizzie, can you go to the next slide? Thank you. Right, so basically what I was trying to do on our call was to say, does it really matter who wins? And does it really matter if it's a Republican or a Democrat? Now, I just want to make sure everybody understands. What I'm talking about is only the stock market. I'm not talking about any other issues that everybody may be thinking about. We're only talking about the stock market here today, right? And so as we proved out with this slide and another slide, which I'm going to tell you what it is because it was just a small amount of information. And what we looked at basically was the last quarter of the election year. And the last quarter of the election year for all these elections, once I averaged them, and for those that this is your first time on, what I did remove was the Obama election in 2008, only because we were already in a pretty big downturn, right? And so I didn't feel that was fair. And so Republicans 2.3%, Democrats 2.5% positive for that last quarter, right? As we tried to prove this, that the actual president, the actual party does not matter. So Lizzie, if we go to the next slide, And you can look, Lindsay, could you move that up just a little bit so we can look at the very bottom? Is that possible?
I don't think I can.
That's okay. I'll tell them what it is. And so the very bottom of this slide has this current election and the last quarter, which is 11.7% positive, right? The second highest quarter, the one that beats it is 1928, right? And if we look, more importantly, if we look at the chart on the right, there's really two important pieces here. And so if we look at Democratic sweep, which returned over the next 48 months, 41% versus a Republican sweep. Now, these are the averages. I want you to understand, these are the averages of what you're looking at on the left. There's really not a whole lot of difference here. There's a 7% difference over 4 years. Do we know sitting here, we're going to make 41% over the next 4 years? We have no idea. But what this tells us is that there's a small difference in the different outcomes. These are all the different outcomes that could have happened. And there is a very little difference. These are the averages of the following 4 years for each election, right? And so what point am I really trying to get across here, right? I'm trying to get across which we did last time, and I believe, you know, this time everybody will come away with the same thinking and the same outcome, is that it does not matter from a stock market perspective. The stock market doesn't care who wins, they only care someone wins. Certainly that doesn't mean there's not going to be other changes. Of course there's going to be other changes, right? But before I leave this slide, you know, my advice here is to stay invested and don't let political emotions affect your decisions surrounding investing. Most likely the outcome of that will be negative to you, right? We've seen it. I've seen it a few times. And I don't think in this election, Doug may be able to correct me on that. Last election I saw, right, where, you know, the other part, the Republicans won and Democrats thought, oh my God, if Trump gets in, and some got out and missed a good run up. So Lizzie, you mind going to the next slide? And so look, if for those that weren't here for the last call, we do have these, we have the last call and all our calls from the very beginning back into March. We have those on our website. You guys can go there and you can look at the last one where we talk in more depth about returns, Democrat versus Republican wins, et cetera, et cetera. So look, this slide talks about some of our predictions that we think we'll see develop with the new administration. You know, as you look at these, you know, most questions that we receive are based on stimulus and taxes, right? Not too many people are asking us much more than that. So stimulus round 3, right? We're in round 2 now, checks are going out. They should mostly all be out. I'm sure some people haven't gotten it yet, but that is going out. Stimulus round 3 certainly is going to happen. We don't know the timing of it. However, you know, I think that we'll see $1,400 come out. That seems to be the underlying amount that's going to come to every eligible person. But just remember, as we saw in the first 2 stimulus packages, and I followed them at length, they were changed repeatedly. So we'll see what comes out, but something certainly will come out, right? What I do believe here for the next, you know, 3, 4, 5, 6 months is that economic recovery, COVID certainly is going to be the top priorities for the administration. Certainly will be, you know, which will most likely move the other issue that we get a lot of questions on that, which is taxes, I believe will go to 2022. I think there's too much work now to get through taxes and to make it retroactive, to get it through soon enough to make it retroactive to 2021. So I think that's going to come in 2022. So as we look on the next slide, right, I kind of just put some thoughts together because look, let's face it, we're very early into this. You know, taxes change on average here in our country, our federal taxes, every 2.5 years. That's how much they change. We're just hitting another change here. Trump's went into place, I believe, 2018. This will change 2022. We're a little bit over, over the time, but it's 2.5 years. So what we hear now is just some very broad thinking, not a whole lot of detail, right? Again, I don't think they can make the detail at this point. But if we look at it, I tried to do some reds and some greens and blues. I just thought were evens, right? Is it going to be an increase or decrease? We're certainly getting an increase. Do I think it's going to be 2021, 2022? As I said, 2022. I made it green because it's 2021, and I think we'll be able to retain the tax that we'll have to pay in 2022. So we hear a lot about high net worth, right? I don't know that I've seen many tax increases for only high net worth. Will it be all or high net worth? I can't answer. If I was a betting man, I would say all, right? But we'll see how that comes out. Tax rates up, capital gains most likely up. Not a high priority, most likely up. Social Security tax. This is not tax on your Social Security for those that are collecting Social Security. This is tax for those that are working and earning. I'm pretty sure we're going to see in this go around a tax increase. Right now, naturally, you've all heard anybody making more than 400,000. Hopefully it goes higher. Don't know if that'll happen, but I'm pretty sure there's going to be a change there. And I think if you can all remember back to when Medicare went to no cap, right? I don't want to call it devastating, but an additional 2.9% on additional income with no cap, I think hurt a lot of people when that happened. Deduction limits, what happens to itemized deductions, most likely will be further limited than it was back in 2018. I don't know if you remember, we had some limitations on different types of itemized deductions. We will see more of that. Corporate rates naturally will go up. It's been talked about. I said something probably 6 months ago on one of these calls. I'm a big believer corporate tax rate should be 0. I think it's a huge mistake. I think economic output is due to low taxes. It's proven by other countries. So look, my advice here is stay tuned, right? Planning is going to change. Tax planning is going to change. You're going to have to, based on your situations, right? You're going to have to be involved in tax planning depending upon situations. So I will report these back out in these calls. And certainly for all of you that have been with me and those that you haven't, I send out a lot of email when tax changes come. So you'll start to see those, right? We try to stay ahead of the curve here. So with that, that's really all I want to hit on. Too early to guess here, too early to really predict with a high level of accuracy. So with that, I'm going to go ahead and turn it over to Doug. If you guys have any questions, certainly put in a chat box. I'm going to start checking them and replying if we get any. Doug?
Hey, Tom, great job. One of the things you touched on was the tax increases for people possibly making over $400,000. So in your view, that's just going to be at the top bracket, yes? The current 39.6?
So currently it's 37. So there's talk about the tax going back to 39.6 and then Social Security being taxed at 15.3% on those monies as well. Right now that caps off around 135,000, somewhere in that range. I don't know the exact number off the top of my head.
Okay. Yeah, I mean, I think some of the planning we'll have to do is, in the event that people have to make large sales of securities for this or that, or who are living off of income and how that's going to impact, correct?
Yeah, yeah,
Okay.
there's going to be a lot of, look, planning's going to become real important here, most likely at the end of this year. Right.
Okay.
I'm a little worried about this year for those that are self-employed. We're starting to talk about, which I never thought I would talk about again. I thought it ended about 20 years ago as S corps. So we can cap wages and, on self-employed and not get to that 400,000. So if they're making, a significant amount of money, we'll cap their wages at the top of Social Security, right? So we get no pushback that we didn't pay them enough. And then we'll go to distributions out of an S corp. I've already had those discussions. And Doug, so let me go to one more piece here, because I got a question from one of my clients who talked about the employee retention credit. And so the employee retention credit has something to do with those that have, employees, and you kept them going through this pandemic, and you kept them on payroll, et cetera. That I will be sending out some information. I wanted to do it last weekend, did not get to it. It will be this weekend, what we have to do and how you qualify to get that. Okay. So I will make sure, and I know this is coming from one of my clients, Dr. Schwan. I'm just going to tell you, Dr. Schwan, you're going to see that this weekend. And so for anybody else that has employees, you will get it too. Everybody will get it. Just to let you know, because I don't know who has employees and who doesn't, especially with all of Franklin's new clients.
Excellent. You all set, Tom?
I am.
Okay, thank you very much. All right, so Lizzie, just jump to slide number 8. And I'm going to point out right now, I am not going to be going through the deck. I just wanted everybody to be able to look at something unless they want to stare at me. So I'm going to jump around, but most of what I'm doing here is just some comments on where we've been, where we're going, and what the portfolios are doing, and hopefully that generates some Q&A, and we'll look forward to doing that at the end. So if you've ever had a fight with your partner, your spouse, or whoever, and I don't know about you, but I don't like being told, don't worry about it, or how about this one? Hey, calm down. So telling you the market always comes back, or not to worry about the market, with this election cycle and so on, it's not helpful, right? So it's similar to you taking a donut when you're hungry. It makes you feel better for a couple of minutes, and then the crash. And then correspondingly, when the market goes down again, you forgot about all of the, the wisdom that you got from us or you read somewhere. So, I'm much more interested in focusing and getting you to focus on what's actionable here. And most average investors attempt to be right. They want to guess the market. They want to try to find that stock that's going to quintuple in 5 months, or I think in the case of GameStop, doubled in 2 days. And one thing that's a truism in trading, and certainly in the market, and in most things really, is you're never as wrong as when you're trying to be really right. So as an experienced investor and any advisor, what you'll take away from that is that you don't want to go for the needle in the haystack all the time. You want to try to buy the whole haystack. And for our purposes, the haystack in our situation is a well thought out financial plan. Our job, our role in your world is to help you design and implement the well-conceived financial strategy. And then more importantly, be there for you when you're tempted to make changes unnecessarily, like calling Tom or Dan or Franklin 2 days before the election and saying, hey, it's time to sell out, or something else. So you also need to reach out, or we'll reach out to you when your plan is going to be adjusted. So the way I look at this, and what I'd like you to look at it, or the way I'd like you to look at it, is answer a question, and that is, what's important about money to you? And that's, that understanding is what it does for you. And the only sane definition that you should use for money, currency, and its role in your life is purchasing power. That's it. It's paper, or it's a credit card, or it's a Zelle transaction, but in essence, money is about purchasing power. And that is the notion that your money needs to increase in value more than the increase in value of goods and services over time. And that's the basic role of your financial plan, is that you want your money to outlive you, not the other way around. So based on that, we're going to assume a couple of things with your portfolio. And that is the well-diversified portfolio will keep pace and probably beat inflation simply from interest and dividends reinvested over time. And most certainly, number two, it will grow in time. The price of a share will grow as well as the interest and dividends that you get. So this advice is not hang in there with the market. It's always going to come back. This advice is always to think about what your money needs to do for you in your world. And if the strategy is working, unless your life or plans change, do not change your investments. You will create much more wealth that way. So let's talk about the last year or so and the lessons learned. Now, there's an old saying that goes something like there's unknown unknowns and known unknowns. The unknown variant will get you. So for instance, the unknown variant we had this year was COVID. The known version is the presidential election. That is to say that we know that with every one of these elections, for as long as all of you have been around, one candidate says about the other, that guy or that woman or whoever is elected, the end of our national life as we know it is coming. It's at hand. And each and every election, and I've been around for, I think, 7 of them, most investors are passionately dedicated to this one idea, and that is, I better get out of the market to avoid this inevitable downturn, which, as you saw from Tom, and as we talked about in September, turns out to be short-term volatility. Now, in the last call, we made the point that there's a very big difference between volatility and existential risk, meaning, I used this example before, there's 2 ways to go mountain climbing. There's actually to strap yourself onto, I don't know I've never mountain climbed because I'm not interested in dying quickly and painfully, but you can climb up something or you can do it in virtual reality. 2 different types of things. One's volatile, one's actual risk. So we talk about that. And, I want to get into something with you, and that is the after viewpoint, and review some of the lessons, or 2 lessons that we've learned from last year. Number 1, the market cannot be timed. Now, this life lesson is that even if it's at its most dramatic turning points, the economy and the market movement can't be timed. And as I said to you before, and for those of you who have not heard me speak on this topic before, we don't care, nor do we know the next 15 or 20% directional move of Apple or whatever. What we do know is the next 100% move. And it's not going to be down, it's going to be up. It's just a question of time. It's, coal, diamonds. Now, we had a profound crisis in February. The market was at an all-time high on about February 19th, and it dropped about 1/3 in 5 weeks. And yeah, that was jarring. Now, there was no liquidity in the bond market, and the Fed stepped in with massive intervention, created this liquidity, stimulus, and by mid-August, we were right back where we were in February. Of course, we had to come back about 57%, even though the market dropped 31. Arithmetic is we had to have a really steep climb back up, and that was it was unique, especially in that span of time. So that was the first thing. Can't time the market, nor should we. Second lesson is that government policy versus investment policy, 2 very different things. Now, you consider government and politics and this hyper-partisan election cycle we had, and 75 million people voted for, give or take, for each candidate. Positive they were right. So guess what? I stand here before you today with the only correct answer, and that is, when it comes to your investments and the government political connection to performance, it just doesn't matter. I'll say it again, it just doesn't matter. If any of you out there from the 80s, one of the great Bill Murray movies is yelling at the end of the movie, it just doesn't matter. I think, what was the movie, Meatballs? Anyway, it just doesn't matter. The market, the stock market, is about creating and distributing wealth. It's based on cash flow, discounted cash flow, and goodwill. That's how you price a stock. And that's what makes the stock go up and down. The government is about creating and distributing power. Never get political and government policy mixed up with your investment policy. So therefore, as we prepare and not predict, and we remind you that the plan drives the portfolio, not the other way around, your plans, your overall financial plans will always be rooted in those values you hold dear and who and what you love, and therefore not attached to the whims of an election or political maneuverings. And I'll leave you with this thought, and that is, it's in essence about consistency. Think of your investment policy like your integrity. It's only meaningful if you stick to it when it's inconvenient. You have to do it. And we're here to support you in that. So our outlook, and this is slide 8, 9, and 10. And those slides show you where we were. I have to admit something, it's a failing on my part. I'm the worst when it comes to these slides. I build the deck, we developed it, Tom and I talked about it 5 times, and I start looking at it and I don't know, I lost interest in my slides. So we'll put them up, but I'm more interested in talking about where we're going. Those slides show where we've been. Lizzie will move them around. And I urge you that this is a good time, if you're interested, to take some notes. If you're so inclined, I'm happy to revisit any of this with any of you if you don't feel like it, or there's no pen handy. Now, in my view, there are aspects of 2021 that are cause for a great deal of optimism. I'm going to go through them really quickly. Forgive me if I'm talking too fast, but I don't want to lose the room. And like I said, I can always come back to this at any time. So we have, number one, we have recovery. We have a synchronized global economic recovery in history, or the largest one in many, many, many years, to begin probably in mid-year. We have pretty good earnings so far this quarter. I expect them to be good next quarter, especially with tech and a lot of the smaller innovation types of companies, and certainly financials are doing really well. And the reopening will continue along with the deployment of the vaccine. And I think there will be a significant more confidence. And through large swaths of the global economy, you're already seeing movement higher, if not booming. Think of the US and the Chinese manufacturing sectors, for instance. And, as they say, animal spirits, that is confidence, is beginning to emerge. So to me, the first thing that we're looking at in terms of optimism is this confidence. Now, stimulus, this is obvious. We've had the largest ever trailing 12 months buildup of stimulus. This is a coiled spring. It eventually has to work its way through the economy. It's trickled down in essence. Now, what $3 trillion worth of stimulus? There's probably close to a couple of trillion more coming. And with this Democratic Congress and White House bent on more aid and spending on infrastructure, that's going to work its way through. And this does have a lag effect. We're going to see this as we get into the second, third quarter. Corporate earnings. So year over year, from last year to this year, we've seen the largest earnings recovery since probably 1934 in many of these cyclical sectors. So the consensus S&P earnings per share has been rising, and right now it's sort of settling in at about $170 relative to a $3,800 S&P. And for those of you who are mathematicians, that is about a 5.6 earnings yield. That's not so bad. Now, my guess is that it's probably a little low because many of the forecasts we're getting are for reasonable growth. I'm seeing a little bit more than that, and that's how we're setting up the portfolios. Labor markets, we have, once again, not to use too many superlatives, the quickest labor market recovery in history. The collapse in the market back in the labor market in March and April, I think wiped out something like 21 million, 22 million jobs in 2 months. The recovery has been historic. May and June jobs added far more and faster than ever. And our guess is that by this time next year, maybe what you'll be seeing is a lot more help wanted signs, and that will be the concern. Underemployment, not unemployment. So valuations of stocks. Now, this is something I'm really interested in, and I see great value here. I think that stocks are discounted relative to where they're going and estimates of those. I'm treating the portfolios as such. I'm not saying my foot's all the way down on the gas pedal, but I'm certainly driving faster than the speed limit, so to speak. So right now, we have a very low discount rate on stocks relative to their apparent growth. And as we emerge from COVID, from a high level, earnings will significantly surprise. So last and certainly but not least, and this is what I feel is most important, the economy in the world has changed with respect to these sectors that have come out of no place, all these innovation types of sectors, these teledocs and the Pelotons and some of these small companies like Moderna who developed the vaccine, and all of these industries that we're hearing about every day, this digitization revolution, the biotech, and this renaissance in manufacturing. This is all, structurally something that's going to be, real driver of corporate earnings and therefore the market as we go forward. Now, going back to something I said before, these are known unknowns. This is why I feel confident about, where we're going from an equity perspective. And yes, we're embracing this. So, Tom touched on this, and I'm not going to get too far into this. I'm just going to basically summarize kind of this democratic control, this light blue wave that we're expecting, and really what this means with respect to the markets. So, there's that term Goldilocks government, not too conservative, not too progressive, right in the middle. It's going to be good for the markets. That means, and once again, I said this in my announcement about the teleconference, and Tom and I stressed this. None of this is political. This is apolitical. So don't throw your hands up and say what's going on here. This is just about what we observe. Stimulus checks are coming, more infrastructure spending, and that's going to be happening as this light blue wave kind of takes shape, and we expect some of this stimulus probably to work its way through. Maybe in March they can get their act together. Markets are going to be happy with that. The markets also react favorably to this very small majority in Congress. Interestingly, it prevents, as Tom pointed out, very large scale changes in the tax code to be made, and also it's going to prevent some ambitious progressive democratic agendas to go unchecked. I don't think it's going to be that easy. So with all that said, I'll get into the models. In particular, what I like to do on these calls is talk about the what we call the moderate model. For those of you new to the call, the moderate model is the model of investments that we use for a majority of the practice. If you're in the moderate model, you're typically somebody who believes in stock and believes in growth, and you have a tolerance for some volatility. You're just not hyper aggressive. Typically, the people that are very, very aggressive are typically people who have a smaller pool of money and then a larger pool of money, maybe in cash or something like that, and they're okay with this, or they're very young. But the model is essentially anywhere from 62 to 68 or 69% in stock at any given time. The rest is bonds, real estate, maybe some cash. So the moderate model performed in 2020 an average of 14 to 19%. And the reason I say average is because it varies with certain clients because of timing of when people put money into the market. We had a lot of new clients and they came in with cash, and we had to deploy that relatively quickly. Sometimes clients have a very large position in a portfolio we manage that we can't sell. Grandpa Joe gave you IBM at $3 a share in 1950, and IBM hasn't been doing much, but we also can't sell it and take a $100,000 tax hit. So in any event, this is in comparison to the S&P 500, which it's a well-known benchmark, which in 2020 did about 15.7%. Now, here's the rub. Our model, the way it's designed, and it's engineered this way specifically, takes on about 33% less risk than the S&P. So on a risk-adjusted basis, you're traveling with the S&P without that kind of downside risk. And to put it in a different way, most of the people in this model, when the S&P was down 31.8% or so on March 23rd, you were not down more than 15 to 18 or 19%. So therefore, the S&P had to climb back up that hill 57%. You only had to climb back up about 17 to 20%. That's relevant because our outlook, the way we manage money, the way we manage these portfolios is that we're interested in winning by not losing. If I only have to scale back up a molehill rather than, Mount Everest, I'm happy with that. Because for the most part in our practice, our clients are close to or in retirement and cannot afford a very large downturn. Now, that's a different conversation. I'm not going to go down that rabbit trail, but in any event, it's about risk-adjusted performance, and I'll leave that there. Now, so the important thing about the models is that we neither care nor can we control what the S&P does, and I'm fine with that. What I'm most interested in is I know with absolute certainty what your model will do if the S&P does that. I need to be able to sit in front of you and say to you, listen, how do you feel about this, Bob? If the S&P drops 50%, you will probably drop 20 or 24%. How does that make you feel? I need that answer in order to decide which model to put you in. So that's why it's relevant to know how your portfolio will react, which therefore allows us to make decisions on how to set you up based on when you need the money and how you feel about volatility risk. And let's see. So the last thing I'll mention is that through March and into April and May, it was quite easy finding relative value. There was a lot of stock really, really undervalued, and it was one of the easier things I ever had to do in my career, just to, to find UPS trading at 89 for no good reason, or Microsoft trading down 25% for no good reason, and just scoop it all up. And now is the art form. Now it's, now staying out of trouble isn't as easy as it was back then because, the market's much higher. We have to pick our spots. Finding value is a little harder. And this is where we earn our money. So we're going to continue to try to provide alpha. Alpha is just a statistical way of measuring how we can use our policy, our investment policy, to stay ahead of the market on a risk-adjusted basis. And with that, I'd love to hear from you in the chat, and certainly if you'd like to reach out and set a time to speak with us. Each of us in our email has a scheduling button. I'm not sure if Franklin does, but everybody knows how to find him, and certainly Dan and Tom and I do, and we're always welcome. We welcome any conversation on any of this, and I thank you very much for your time. I'm gonna hand it back to Lizzie and Tom.
Yeah, so if anyone has any questions, please feel free to send them in the chat box, or you can use your audio and you can ask them, and we would be happy to answer them.
This is the part where I tap dance or something, or I try to find something clever to say. So, nobody in my practice is ever that shy, but I'm going to start looking around the room. I'm going to start calling names.
So Doug, look,
Yes.
I want to tell you how I see things here. I see things very simply, right? When we, at this time last year, not exactly, but give it 2 more months in March, we were at a point, and when I say we, all of us on this call, that basically everything we knew was coming to an end, right? And you and I spent a lot of time in the middle of the night having some pretty long conversations to try to do all the right things, and look, I know that this has affected a lot of families, but overall, we all made it here. In our job, right? The markets, which it just is, unbelievable, came back and produced what they produced. My phone calls with clients today are basically, isn't this unbelievable, right? When we look at the year returns for last year, and we had this horrific event, horrific outcomes. Some states are still more impacted than others, and so as I look back, I kind of want to say this to, the newer people on. Doug did a fantastic job at making selections. He would call me, he'd ask me my thoughts. I never said no to anything because, his picks were always really, really good. I want to thank him for a great year. And I want to thank the people on the call and our clients that aren't. Really, I'll call it a leap of faith, right? And it really wasn't a leap of faith. You already had the faith in us, but maybe the faith to stay with us as we were talking through March, right? I remember March like it was just hours a day, and I only know of one person that left in that time frame, and I don't know, maybe I'm wrong. If I am, Doug, tell me. That person locked in losses. They can never get it back. They can never recover. They're certainly not in the market now, right? We push them out, but they're certainly not in the market now. And here we are at all-time highs. Should all-time highs scare anybody? The answer is no, right? After a downturn, we always have more all-time highs. That's the way the markets work. They just keep coming, right? From what Doug was saying, from my beliefs, from what we think the stimulus is going to do, we're going to see many more all-time highs this year. I can't say that with any accuracy, but there's a lot of money being pushed into the economy, right, through stimulus. So it's great that we get to start this year where we think we won't have another horrific event like we had last year, right? Don't let, and I talk to my clients, so now I'm talking to everybody about this, do not let your emotions make your decisions. I'm not, Doug isn't, Franklin isn't. We have no emotional connection to your money, none. You do, but we don't, right? We're going to do what we believe is 100% absolutely right. We did, it worked, right? And here we all are, benefactors of keeping that faith that you guys had in us and in the market. So I think this year should be easier for us. I just want everybody to know we're here, right? We're here to talk with you, to stay in touch, to talk about these things that are difficult, right? We had a lot of difficult stuff last year. Hopefully it's an easier conversation this year. We don't have to have them, but we are here. So look, I do not see. So I got one question here, Doug. I'm going to put this to you. Overall, what is the prediction for the market? In short, I do worry about the end of the earth. Now that's a laugh. So he's not, whoever sent this to me is not worried about that. But
I always love when I get serious questions like that, and then there's an LOL at the end. Because
that's it. That's what was there.
Even though I see LOL, that's nervous laughter. Maybe there should be an emoji for nervous laughter. So, all right. So number one, the world only ends once. So let's put that out of our minds. If the world ends, we don't have to worry about the market. So with that assumption, I don't have a prediction on where the S&P goes, of course. There is no prediction. The fact is the market is trading based on earnings and based on where earnings are going. So I think that the answer to this person's question is, and I'm not being a wise guy, I think that is definitely somebody who needs to talk to their advisor, where there can be a Socratic kind of give and take conversation about how he or she feels about volatility risk and when they're going to need their money. Because when you worry about the market moving, what you're really saying is one of two things. The money that I have invested, I may need pretty soon, and I'm nervous about that, which tells us you're not set up properly. Or B, I don't know if I like the idea of this up and down, and I think I gotta reevaluate. Both of which are very valid conversations. So, I'm not going to answer where the market's going. I'm investing the portfolios as if they're going up. I'm finding a lot of value. I will tell you this without going down a rabbit trail here, that I did do some selling at the end of the year. Also at the beginning of the year, I did some selling. And a lot of the stuff I bought back in March, I am waiting till a year and a day happens where I can sell it. And it gets cap gains treatment rather than regular income treatment, because there's a lot of other things I want to buy. I think a lot of the things I own are tapped out from a valuation standpoint. So for instance, we bought UPS at I think 89. I was watching that stock for 7-8 years, and it's literally the definition of watching paint dry. It doesn't do anything. And I was all excited one day. I called Tom, I think, and I'm like, who could care less? UPS is 89. I can't wait to buy it. So I bought it. I think it moved higher than Amazon in 9 months. It's at 160 or something like that. And it boggles the mind. Now it's just going to sit there at this new value. So there's a lot of stuff out there that's fairly valued that I want to be in a position to buy. And that's our outlook. So I know this is an exact answer to the question as to where the market's going, but I think the market's going up. I think there's value in the market, and I'm acting accordingly. So I hope that's helpful, but I do think whoever you are, reach out to your advisor. I think that's a great idea.
I can
yeah,
answer
Tom.
that question, right? Because I know where the markets are going. They're going up and they're going down, just like they have for the last 100 years. We just don't know where they're going to end up on 12/31, right? We all have kind of a sense based on stimulus, et cetera, but there's really no way to ever say, with any accuracy. We could say it, and boy, if we hit it, that's one thing. We'd come out and say, hey, we look at what we told you last year. It's just not what we do. And so, look, I think Doug hit it right on the head. We're in this, you're in the market for some type of long-term type investment. If the money is shorter term, then maybe we need to make a change. And let me just give the people, because I think this is Franklin, I believe this to be one of your clients. So they've not heard what we've done here. So back in March, at one point, and Doug, I can't remember the point, we started going to cash, and I think we went to 50% cash. So we had this 50% cash that we sold pretty early on in the downturn. So it either was
we sold bonds.
bonds.
Remember, we sold bonds.
You went into cash.
We didn't sell stock. I wanted to make that distinction.
Yep.
Because bonds were completely disconnected from reality, but we didn't sell stock. We bought stock.
Right. And my point here is we went to cash, right? Bonds were moving down. We went to cash, which made those monies either it wasn't depreciated at that point or very small depreciation. Those monies were available. And as I say to my clients, what's the difference in what happens with the other 50%? That's years. You'll take years and years and years and years to use the cash up, right? And so this is the second go around. We've done this. We did it in 2008, where we went to a large, actually bond holding then, right? That told us to go to cash, right? Because bonds didn't do well there either. So, I think what Doug said is exactly right here. If there's concern about downward trending, no one's ever concerned about upward trending. That's all good stuff, and it makes us all happy. The downward trending, then we all should sit and have a conversation.
Right. So Tom, right. The next question. Thanks, Tom. There's another question in the chat. I'm going to answer this to start, but I want to see if you have some feedback as well. So the question is about selling and getting substantial gains now before a theoretical tax increase hits us? My answer on that is definitively no. You know, if you get out of the market to avoid, say, a 4, 5, 6% increase in the ultimate tax, then how do you solve the problem? And the problem is now you're out of the market. So the 2 or 3% dividends you're not getting, you lose. Any appreciation in the equity that you had, you also lose. And instantly you pay gains on what you just sold. So unless you need the money within a short period of time, you don't make any changes to your allocations. You know, there's I've told this story before, but for those of you who didn't hear it, there's a famous story about the owner of the Dolphins back before Jeffrey Ross bought them. I don't remember what year it was. Lizzie, do you know what year that was?
I don't remember. I know Ross was more recently, so maybe the
Probably
90s.
like 2000 or something like that. And he was it was when Obama came in. So I think it was probably like 2007, and he sold the Dolphins. Of course, the real problem was the Dolphins are never the same. Parcells quit, you know, and whatever. As a lifelong Dolphin fan, it was hard to see. But he ended up selling the team. Tax law didn't really get changed too much. But you know, unless you have a situation like that where you're talking about losing $100 million, to get out of $50,000 or $100,000 of equity or $10,000 in equity, to play the game with 4 or 5 percentage points in cap gains treatment, that may happen. It's not a good move. So, you know, think about your liquidity needs. If your liquidity needs haven't changed, don't change anything. You'll do more damage than good.
Well,
Tom,
and the other issue, Doug, right, is we don't know what the change is going to be.
Right.
There may be no change. Certainly it's being discussed, but we don't know what it's going to be. If we're fortunate enough that any tax changes are not retroactive and will be in 2022, let's assume that I pick that right, I project that right, then we can sit and make decisions. If we sell now, what does it cost? If we sell then, what does it cost? And what does that do to your long-term plan? And what does that do to your return? Because then you're taking cash and where are you putting it?
Right, projections.
Right.
So
and
listen,
remember what I said at the beginning here, which is really important. I got to tell you, 2.5 years is the average for tax changes. So what happens? Republicans come in, taxes go down. Democrats come in, taxes go up, period.
Yeah, and you got
So-
elections in 2 years.
Well, we have midterm elections, right?
Yeah.
Typically that changes, right? A House or Senate will change. And it's either 4 or 8 years till we see another Republican. It's typically an 8-year run.
I hear
Right.
you.
In
Hey,
my
so
adult,
everybody, Tom, I'm sorry to interrupt you. We're running out of time and we're getting more questions that I wanted to get to.
Right.
Okay, good stuff. So, Tom, this is more in your department, I think, and this is also kind of a like microeconomics 101 type of question. So, will jacking up the minimum wage to $15 have any, if at all, impact on the market?
my position is no. We will have an impact on unemployment. There will be more unemployment because there's going to be a certain amount of employers that can't afford that 15. So what they do is they're going to either outsource overseas. They'll somehow automate, right? So some of those people will go away. I'm not a big believer in minimum wage. If somebody wants to work for $10, they should be allowed to work for $10. If they're only worth $10, they should be allowed to work for $10, right? The way you earn more wages is you have more value.
Right.
I'm a big, I don't support minimum wage at all.
Yeah, Tom and I are believers in meritocracy. So, okay. Yeah, I think whether it has effect on small business is a different question, but no, it's not going to affect the market. Next question is, well, this is a doozy. How much longer can interest rates stay this low? And what are smart companies and homeowners doing to take advantage of low interest rates? So I'll let the real estate tycoon talk about this a little bit.
Look, interest rates, it's just amazing that we have been down so long and we keep going down. I've been saying for years, oh, it's got to go up. It's got to go up. This is a tool that has been used to move the economy. I don't know how we get back to any normalcy. What everybody on this call knows what normalcy is, 5-6%, right? I don't know how we get there. You know, interest rates now are, the low interest rates are just pushing real estate through the roof, right? It's a meteor, I can't even say the word. It's a hell of a rise in such a short amount of time. You know, we're kind of looking at it going, does this last? Right. And I see a lot of different answers there. Some people say, oh yeah, this now will last. Some will say it won't. As I look at everything, and you can look at the stock market, you can look at real estate, you can look at Bitcoin, you can look at gold. When stuff goes up in such a quick pace, normally it comes down. You can't say that real estate's coming down. What are smart people doing? Look, if you've got debt at a higher rate, certainly you refinance, right? Outside of that, what else can you do? I wouldn't borrow money. So, you know, sometimes we have questions. I do. Should I borrow money and put in the stock market? Absolutely not. It's not nothing that we would ever support. So the best thing you can do, refinance your current debts.
Yeah. Yeah. It's dangerous to do a carry trade. You know, a carry trade is where you borrow money at one rate to invest it in a different rate. That's risky. We saw that go badly back in 2008, right? Remember everybody losing their houses? Tom and I, we don't allow anybody to trade on margin here, which is effectively a way to borrow to buy something else. You know, another great way of looking at a low interest rate environment in a carry trade is what's going on in the United States with the weak dollar. So now our exports are cheaper everywhere. It's cheaper for Europeans and other people to buy stuff here. But in essence, Tom's point is right. The actionable way to handle this is look at the opportunity cost. What can you do to reduce your cost of capital and do so? And you know, nobody's thought that from 2006 to now, interest rates would be close to zero. I think for the foreseeable future, that's where they're staying. You know, that's probably as safe of a bet, Joe, as you know we can get to an answer. So I don't see any other questions in the chat right now. You know, I will. I'll wish everybody a good night, and you know, before hanging up, I'll let Tom say good night. But I want to welcome everybody that I have not yet met. I love seeing friendly faces, and even if I don't see your faces, I see names, and it's great to see everyone. I wish everyone a very healthy and fulfilling year. It's been a rough 12 months for a lot of people, and I hope you're faring well. I hope this scourge, this COVID didn't affect you too deeply. I know some people on the call that I'm friendly with. We lost a dear friend last week, and you know that's sad. And but I am wishing everyone the best. I'm looking forward to speaking with you and getting to know some of you that are new friends. And with that, I'll leave it with Tom, and we'll say goodnight.
Thanks, Doug. Hey, so I really appreciate everybody's time. You know, we do these now. You know, we're back and forth how often to do these. We're going to do them when necessary, and we like getting information to you. I certainly got to agree with Doug. Last year was tough. We don't know that this year won't be tough. We don't think it will be anywhere near as tough as 2020, which all of us will be happy about. You know, just realize as we go through whatever the next piece may come, and maybe it starts after we get off this call, maybe it starts tomorrow and next week, next month, we don't know. We're here to make the decisions to keep your money doing the best thing we can do, and to avoid you making any mistakes. That is a thing that tears me apart, when people make mistakes and I can't talk. And so call us, stay in touch with us. We're here. I appreciate everybody's time. I wish everybody a good night. And until the next time we speak, have a good evening, and I'll talk to you very soon. Thank you.
Thank you everyone for coming. Stay tuned for more updates on our next calls, and we're always here to help. So thank you all for joining. This was awesome.